Hey everyone, welcome to Build Onchain. My name is Nishad. I'm a developer here at Eco, and today we have Marcin Kaźmierczak from Redstone Oracles.
Hey
Marcin, why
everyone,
don't
great to
you?
be
Yeah,
here.
Marcin, why don't you tell us a little bit about Redstone, what you guys are doing? What's coming out recently?
Yeah, happy to. So I'm Marcin. I've been in the crypto space since late 2017. I wrote my bachelor thesis about blockchain and Bitcoin back in the days. That was very interesting for me as a graduate at Warsaw School of Economics. I majored in quantitative methods in economics, so statistics, econometrics, these kind of fun number games. Then I worked in a couple of startups, one in the crypto space, some in the non-crypto space. I worked at Google Cloud. And in late 2020, together with the technical founder of Redstone, Jacob, we started Redstone as the innovative oracle because we identified that if the future is with thousands of chains, millions of assets and tokenized assets, and limitless number of protocols as we see in the internet normally right now, then we need an oracle infrastructure that just scales and can follow the innovation pattern. So from the day one, the design principle has been flexibility and being able to update the infrastructure based on the best technology available on the market. And fast forward to today, we are the fastest growing blockchain oracle on the market with over 170 clients, including Compound, Venus, Morpho, Spark, and many others, present on over 110 blockchains like Solana, Ethereum, Arbitrum, Optimism, Base, Ton. I could go on and on. And today I'll be very happy to talk a little bit about our new product, Redstone Atom.
All right, Marcin. Yeah, let's jump right into your presentation.
All right, so let's take as an example Compound, which is, I think, the first big lending protocol in DeFi. Compound was launched even before Aave, even though Aave right now is the biggest one. Aave, by the way, in the beginning was named ETHLend. Those that were in the market back in the days can remember that was an interesting one. And Compound was the bigger market that launched earlier, but then over the course of the years, the power shifted a bit, but still Compound is very much present with billions of dollars in the markets right now. As you can see, it's $3.5 billion across all the chains supported. And today we announced that Redstone Atom launched on all markets on Unichain from Compound. So as you can see, there is a high utilization ratio of those borrow-lend markets. It's above 90%. And for those that are not super familiar with lending, let me quickly explain how it works. Imagine you've got one Ether that today trades for simplicity at $4,000. And you believe that Ether will keep growing, so you don't want to sell it, but you would like to access some part of the liquidity that is within this asset, because in theory you have $4,000 of liquidity in it. So you can go to Compound, you can deposit Ether as your collateral, and then essentially borrow against Ether, for example, USDC, so dollars. You can do it up to a specified ratio, which is called loan to value. So imagine you want to borrow up to 10% of what you deposit. So you borrow $400. You have $4,000 as collateral and $400 as a borrow. So 10% worth of your deposited asset. Mm-hmm. Now, if as an asset is volatile, so I can bring right now on my screen app.redstone.finance, which is our Redstone web app. And you can see on Unichain the assets that we support over here that are utilized on the Compound markets. So let's look at ETHUSD. Compound is using push oracles. It means that it uses an oracle that delivers data on chain in intervals. Those intervals are deviation thresholds. So the difference between the last update that lives on chain versus what's available on the market, and heartbeat, which is a regular time interval. In this case, it's 6 hours. So to explain a deviation threshold, you can imagine that ETH would be trading at $4,000, and then deviation threshold being 0.5%. Then the next update would be only when ETH goes up or down 0.5%. So the only moment it goes up $20, so 420 or 3,980, only then the next update is going to happen on chain. If the volatility of ETH throughout, let's call it an hour, keeps between 3,980 and 4,020, the on-chain value would only be 4,000 all the time. So from the very design of that oracle, Compound has to accept that the answer on chain is up to 0.5% wrong. So you, from the beginning, you accept the price on chain is inaccurate in terms of what's available on the market. The reason it's constructed that way is every update on chain requires gas. So every time Redstone updates the price on chain, then we pay some gas to make it. On Unichain, thankfully, it's not much, but on Ethereum, it can be, for example, $2 right now. And there were days of, I don't know, CryptoKitties launch or EigenLayer airdrop where you would pay $50 per transaction. So it turns out to be costly. And unfortunately, there is a high correlation between network volatility and congestion. So when ETH is very volatile and changes in prices, you have to update frequently on chain. And also the gas is more expensive then. So this is a kind of like a death spiral for oracles.
Okay.
And now you can see in the last day the updates. So imagine on the 29th of July at 4:20 a.m., it's traded at 3,748 and 81 cents. And the next update was 50 minutes later because it appreciated about this 0.5%, right? So you can see that in practice, sometimes these updates are very close to each other. So over here, it was between 20 minutes because that was a very volatile period. And there are moments when it's not so volatile. So between midnight of 29th of July to 2 a.m. of the same day, 2 a.m., 10 minutes, there was not that much volatility. So the update hasn't been triggered for a very long time. And you can, ETH is pretty volatile asset in general, but you can imagine an asset that is not so volatile. And then if for 6 hours no updates was triggered because of deviation threshold, you still update due to heartbeat just to make sure the price on chain is not stale, right? So that the protocol can understand that the oracle is still functioning and keeps updating. Now, this is how it works without Atom. Without Atom, imagine a liquidation threshold. Right now, the price is at 3,778. And imagine the liquidation for some of the borrow lent position would be 3,780. So only less than $2 more than what's present right now on chain. But that price would not trigger an update on chain.
So you wouldn't know until it changed even more than that, potentially.
Exactly. So this is the perspective of Compound, because oracles work on a network, right? Like I show you not Compound Oracle, I show you Unichain, and every protocol on Unichain, including Compound, is using that oracle. Now, for Compound, what would matter is this 3,780 in this example, but Compound is not going to get this update. It's going to only get an update when 0.5% is going to be hit as the deviation threshold. So there's going to be a lag in liquidation that is already available on the protocol, but it's not executed because the oracle has not updated it on chain. And this is dangerous. Why? Because there is a position on Compound that is, let's call it, eligible for liquidation. And there's always a buffer between the loan to value and bad debt. And let me explain bad debt very quickly. Bad debt is a situation when the collateral that a user put into the protocol is worth less than the borrowed assets. So no one is incentivized to close such a position. So you can imagine this one ETH sitting on the protocol that initially was worth $4,000. But imagine in the very beginning, I borrowed $2,000, so 50% loan to value. And then imagine ETH starts to plummet very quickly because of whatever reason. And then at one point, an Oracle didn't manage to update it quickly enough. And the next update is at 1,900. So now you have a borrowed $2,000 of USDC, for example. And in the protocol, you have 1,900 of worth of ETH. So no one is incentivized to pay back this $2,000 to get this ETH, right? Because right now it's worth less than what you would repay. And this is called bad debt. So the reason liquidations work that way is to protect the protocol from the bad debt, so it keeps being solvent.
Okay.
This is in simplicity how it works. And now what Atom does is the first time, actually, let me also show, I wrote a really detailed article about that, where I explain like in detail how Push Oracle works and why they were designed that way in terms of like the gas and other aspects. And there's also a second problem with the Oracle updates, as I told you in a moment ago, which is there is a leaked value from each liquidation. Why?
So can I just ask you a question? I just want to make sure that I'm understanding this correctly. This is pretty new for me. So basically the protocol is the one that would suffer in this case, right? If you go below, if the worth of the assets that are borrowed against is less than what they were borrowed for, then the protocol basically has lost the difference between those two, and it's supposed to be like risk-free to the protocol between lenders and borrowers.
Exactly.
So, and then the issue with the push is that basically the protocol could find itself in a position, or I guess, yeah, it could find itself in a position where nobody wants to close those positions at all. And okay, I think I got it. Yeah.
So there's a specific period when so ETH is maybe not even the best example because ETH is one of the most popular assets in crypto. But you can imagine a longer tail asset that would have less aggressive deviation threshold. So sometimes we set it up for 1%, sometimes even 2%, just because an asset might not be that popular and it's very volatile. So it's expensive to keep pushing the Oracle on chain, right? So you're accepting this deviation being larger. And then there can be like, those extreme edge cases, or just market participants can try to create those kind of extreme edge cases, because in the end of the day, they can create a moment that a protocol is hurt or they benefit from the whole situation. And the goal of the protocol is to make sure that within that buffer, which is between the moment the position should be liquidated. So liquidation threshold can be, many times it's around, let's call it 80%. So between 80% worth of the loan to 100%, this 20%, let's call it, is a liquidation like buffer to make sure the system works as expected. But imagine you set up 20% loan to value and your competitor set up 18%. And it means that someone can go more aggressive on leverage on the other venue. So most likely those degens, and there are plenty of degens in the crypto space, would go to the competitor. So it's a kind of like a market when all the lending participants are incentivized to offer the best rates up until the risk profile they are willing to accept, in a sense.
Mm-hmm. Okay.
And now the second problem is that with each of this liquidation, the protocol is leaking value. Why? Liquidation is usually a profitable action to do. So if you're a liquidator running liquidation bots, you do so to get profit. How do you get this profit? Is because of this buffer. So imagine loan to value was 80%, and the protocol offers up to 10% worth of collateral as a bonus for liquidator to close the position. So there also has to be some incentive for those bots to keep closing those positions. Otherwise, no one would do that. And if you're running a liquidation bot, you see that update on chain. So imagine there is right now an update on chain that says $4,000 for ETH, and you want to liquidate it that very moment. you have to submit the transaction that liquidates the position. So it's a two sequence. An Oracle updates on chain, and then you submit the transaction to close the position and liquidate the collateral. The problem is everyone wants to do that because it's profitable.
Right.
So people would bribe MEV operators, a maximal extractable value. So essentially like the, for those that are not familiar, the infrastructure on a network that orders transactions within a block to make their transaction as the first one, to include as the liquidator one. So you can imagine that 10% is what is offered to the liquidator. And this liquidator many times would pay 9% out of 10 to the MEV searcher just to include his liquidation within the next block so that he's the one to liquidate. Because for him, it makes sense because he still gets this 1% at least. And then who is the best of is the MEV operator that included that transaction into the block. So someone who's not even in the whole process, so it's not a chain, it's not a protocol, it's not a user that borrowed that gets liquidated. No one from this value chain is getting this value. It's the MEV infrastructure. And in our view, it's a problem. And as I mentioned in this article over here, if you want to check it out, my handle is Marcin Redstone. I posted it like yesterday. Up to date, it's been $500 million that has been leaked throughout lending protocols since the beginning of DeFi in that way. And via implementing Redstone Atom, what we do is we allow for application-specific sequencing so that liquidators don't have to pay the MEV searchers to get their transaction included. So I'm going to share right now an article that is on Redstone blog that goes into detail. The reason it's called Atom is because the price update happens atomically with the liquidation. So there is no, I told you there was a lag between. In regular circumstances, there is a price update and only then there's liquidation. And we bundle those two into one transaction, making the price update already with the liquidation. So you can see that without Atom, the first problem would be that the liquidation would happen later. So there would be some lag between. And two, those sequence would be twofold. And here is like onefold. How it happens, here's a bit more technical diagram, but let me break it like fairly simply. Before the price is updated on chain, Fastlane, which is our partner, is running a very quick auction for liquidators off chain, not on chain, off chain. Anyone can participate, and they're bidding to get a special signature to liquidate a specific position. So imagine this 10% that is a liquidation bonus. Again, here, those liquidators can bid this 10%. And remember, if they don't take part in this auction, they would have to pay 9% anyway on chain, right? So here, they should be incentivized to pay, let's call it up to 8.5%, because they are still 0.5% better off taking part in this auction rather than the one that is going to happen on chain with MEV infrastructure. So what they would do, they would bid, for example, there's one liquidator bidding 7%, the other liquidator bidding 8%, and then the winning one is, for example, bidding 8.5%. So we get an ordered list of liquidators that want to bid in this liquidation auction. And that list of auctioneers with their bids is delivered on chain atomically with the transaction. And then the execution of that is happening on chain in a try-catch loop. So the first liquidator gets a chance to liquidate. If he fails for whatever reason, the second one can go, and the third one, and so on. And the one that ends up liquidating is actually the one paying for the liquidation to happen. And the value that is captured is redistributed back to the protocol and part to the Oracle Redstone for running the whole infrastructure. And the beauty, one of the biggest two beauties of this whole procedure is, one, it requires zero code changes. So the only thing you need to do is to inform Redstone that you want to apply that on your infrastructure. And two is that this whole auction lasts maximum 300 milliseconds. And let me repeat that, 300 milliseconds, which is 0.3 seconds. So it's like flash auction. It's very important because what we are fighting against is this delay, as I explained before, right? So we already have like seconds or even minutes of delay in this price update. So we want to make it as quick and as atomic as possible in the first place. So this is how Atom works. It's available on Unichain, on Compound, Venus, and Morpho, and we are rolling it out to other protocols as we speak.
That is so cool. So this is like, it's almost like the protocol is its own kind of like MEV sequencer, right? So, you know, if it's a 10%, what's it called? 10% like reward that's given to, or that would have been given to the liquidator, and, you know, 9% of that would go to the MEV. Now that 9% is going to, I mean, it's like for Redstone, of course, but then it's going back to the protocol. So essentially they've cut their 10% down to basically 1%. That they're giving
exactly. And who is worse, because someone has to be worse off, right? We don't generate new value in a sense. We more like redistribute the value. So the MEV infra is getting less. They are getting anyway from, you know, dexes and other positions, but liquidations are usually very lucrative. So if you liquidate a $100 position, not so much. But we've seen positions being liquidated of, I don't know, $50 million or $20 million. So then if you apply those percentages, then it does make sense. And for the protocol, right now they get zero, nothing. So even if they were getting 1%, that would be already better. But they're getting like a large chunk of it. And we've been running it on Unichain already for quite a while. And we've observed 100% success rate. This is also cool because what's the worst case scenario? Worst case scenario is a 300 millisecond lag. Why? Imagine this whole infra explodes, like the auction doesn't happen, whatever. After 300 millisecond, anyway, Redstone is sending an update. So there's always a backup throw that is the same as without Atom. So the worst case scenario is status quo. The best case scenario is captured like new liquidation.
That is really, really, really well designed. I like that a lot. So in the worst case, you just the same existing flow with the MEV, taking whatever percent they take, but and
exactly
100% success so far. That's awesome. Super cool.
Yeah, so that's all I wanted to present today. There's also like a talk I gave at FCC in July in Cannes about that specific topic, but without revealing the whole product, but talking more about the problem. So happy to also deliver those kind of materials for the video so that people can follow as they want.
All right, cool, Marcin. Thank you for that that presentation. That was really informative. This is. It seems like a really cool product. I'm excited to try it out. Couple questions. So it seems like you guys operate fully on like you operate on different chains. How would an application kind of like hook into Redstone Atom, for example?
Yeah, that's a really valid question. So we operate at 110 chains, over 110 in a pull and push model. The specific chains that we support in the push model are in our app.redstone.finance application. And we can roll out Atom on any EVM chain because the protocol is EVM compatible. Non-EVMs like Solana, Sui, Ton, we can work on depending on the demand. But if you're on EVM chain and would like to subscribe to Atom, only thing you have to do is start using Redstone feeds as a protocol, as a lending protocol, for example, and then inform Redstone team that you would like to have it switched on because it's per protocol. So you just have to let us know that we should enable Fastlane auctions on those price updates before they go in.
Got it. And then can you talk a little bit about push versus pull models? I think you'd explained the push model earlier. I'm kind of curious about the pull model too.
Yeah, so the push model, as I explained, delivers data on chain in intervals like deviation threshold and time, whereas pull model looks at the freshest data. So it looks into some off-chain component. In our case, it's data distribution network. It observes the price updates that are over there. And imagine again a protocol. So one of the protocols that is using Redstone pool model is Gearbox. If you are going to sign a transaction on Gearbox to create an imposition, the moment you sign a transaction, Gearbox is the protocol is going to call this off-chain layer of Redstone, fetch the freshest price that is available with a signature of the data providers, take your transaction, to your transaction call data, attach the signed data package, and then you, as an executor of the transaction, delivers it on chain together with your transaction, essentially. On chain, the package is extracted. The signatures are verified that you have not tampered with, because if you have changed the price, then the signature is not going to match one of the providers that are whitelisted. If you have not, then the price is read and the transaction is executed. The reason it's called pool, I like to call it on demand. It means that only when there is actual demand from the user of a protocol, then the price is delivered on chain. And also, a beauty over here is that the user is paying for the price update. You are going to pay 1% roughly premium on the gas. So instead of paying a cent, you're going to pay a cent and a fraction to execute the transaction. And whenever there is a liquidation happening, a bot can trigger that flow as well, right? Because you can imagine that the position is underwater, and then no one is actually interacting with the protocol, but you need a fresh update on chain. A liquidation bot can also trigger that price update, because if you think about it, the only thing that is needed is that the on-chain signature verification comes from the whitelisted data provider from Redstone.
Got it. Okay, so why would you choose a, like, I guess it seems to me that like the pull model would provide you with like a perfectly up-to-date price, right? Since you're fetching it on demand, as you said. So I guess like in what situation, why would I want a push rather than a pull?
It's an excellent question. And Redstone started as pull-only Oracle. So the one that sounds more reasonable because it's fresher update. However, we learned ourselves that developers prefer the push model. They like that in the on-chain storage of a chain, there is a latest update available because of the logic, how they create the applications. And push model is right now used by 90% of the lending protocols out there. So it's used by Aave, Compound, Venus, Spark, Morpho, Fluid, Yay. I could go on and on. There are actually very few, like Gearbox is one that uses, actually they use both push and pull. So they use Redstone for the pull model, and I think some Chainlink as backup. I'm not certain like is the setup, but it's so much baked into the developer comfort, let's call it, the push model, that people just prefer it that way over to pull. But I do believe that as we progress as the industry, in the years to come, the innovation is going to happen more in the pull model. However, there is also a set of chains where the gas is so cheap that you can just keep pushing the price on chain. And then there is no need for the pull model, because in theory, if you're going to update every single block, then you don't need a pull oracle, because anyway, you're going to have on chain the freshest price available. And this is what we created on Mega ETH right now. So Mega ETH is this blockchain that creates blocks like every 10 milliseconds or quicker. So at least 10 blocks a second. And Redstone created the fastest oracle that is available on the market called Redstone Bolt. And we deliver price update on chain with every single block. So in that case, the pull model stops making that much sense, because you have the freshest price anyway in the on-chain storage.
Okay, that makes sense. And these, for chains where gas is not that expensive, that's like becomes a lot more affordable to do.
Yeah, but for Ethereum, if you were to update every block, I actually write it literally in the article I shown before, for a single price feed with current gas prices, which are cheap, $2 per update of an on-chain storage is fairly cheap. You would pay $2.2 million a year for a single feed, right? And then you have to extrapolate that for other feeds, and you have to also take into consideration the high congestion moments.
Right.
When you can spend, for example, I don't know, $100,000 on a day because it's super volatile and the gas spiked.
Yeah. Okay, this makes sense. Cool. And then so it seems like Redstone is built specifically for like lending and like these types of protocols. Is there any other kind of stuff that you guys are looking at? Any other like customers of different types that you think would be interested in this? I'm just kind of curious.
In oracles in general, yeah. So right now we are seeing a lot of tokenization platforms. For example, Securitize is one of the biggest over the world, if not the biggest, and they are a client of Redstone. They chose specifically Redstone as the primary unofficial oracle provider. And when you have a tokenized asset, so imagine you tokenize a T-bill, this asset lives on chain, at least the token representation of it. But token representation does not have the information about the price of the asset that lives on off chain, right? So there needs to be an infrastructure that delivers that price, and this is Redstone. So an example for BlackRock Biddle, we deliver the NAV, net asset value, every 24 hours. So if you think about, let's call it $1 billion tokenized T-bill, right now it's 1 billion, and in a year it's going to accrue 4% of the value. So every day it also accrues a specific amount. That's what we deliver on chain. So if you want to use it in example as collateral, so the best collateral in crypto are the yield bearing assets. Why? Because today you put collateral in, and if it's as yield bearing stablecoin, then you are almost certain that over time the value of your collateral is going to only grow. So you're not going to have this problem I told about before with the liquidation. Right. So the only way you can get liquidated in that case, so imagine you put $1,000 that constantly grows slowly, is if you borrow against those stables a volatile asset. So imagine you borrow ETH. So in essence, you are shorting ETH, and ETH starts to go up. So the value of your borrowed asset in that case starts to appreciate. Then at one point you can hit the liquidation threshold. Someone can deposit back the ETH to the protocol and take your dollars.
Okay, I see. Cool. I think that's all the questions that I have. Marcin, is there anything else you wanted to talk about?
I think for now I'm very good. I do believe the stablecoins and tokenized asset revolution will continue in 2025, and I'm extremely excited about welcoming large financial institutions such as BlackRock, Hamilton Lane, Apollo, all of them being Redstone clients already, and the newcomers like JP Morgans of the world to also embrace the on-chain settlement and expansion. And I'm extremely bullish on the blockchain ecosystem in the months to come.
Hell yeah. Excited to hear it. Cool. Thank you, Marcin. This was really informative. Learned a lot about lending protocols and about the differences between oracles. This is super awesome. And again, congratulations on your guys' launch of Atom today. And yeah, thanks for tuning in, everybody.
Thanks a lot for having me. That was fun. If you want to keep track of Redstone, follow me on X, Marcin Redstone, and Redstone_DeFi is the official Redstone account. And we'll keep cooking. We are long-term builders, so looking forward to seeing you guys. Cheers.